So let me share my screen. And I mean, I don't want to confuse you with any of this, what's showing. I just, I want you to take a look at literally if the screen was blank, but you had two things going on. You had calls and you had puts. There's two types of options when it comes to the stock market world, and that's calls and puts. That's it. What you do with those does vary, and that's where the complexities come in and the strategies of all the things that you can do with these. But like I said, what financial people do within their companies, or when you're an investor or an entrepreneur, the way that you make money is by multiple things, right? I mean, what one person does that's different than another person. You know, you might be in a different service and you might offer teaching, whereas the next person might offer delivery. So with options, there's different strategies that are involved within just these two categories, and that's calls and puts.
Okay.
But to keep things simple, I'm just simply explaining what you do when you buy a call option and the theory behind it. So like I said, let's do a comparison of the stock market world and the real estate market world. When you do real estate options contracts versus stock options contracts, they work very similar. You're literally paying for a contract. You're buying a call option when you want to buy that contract and say, hey, in a certain amount of days or a certain amount of time, and that's where you get this. These are expiration dates. That means when I start messing with options, options expire, whereas just buying shares outright, there's never an expiration to that. When you own a share, you hold on to it until you sell it or that company becomes bankrupt and you're forced out of it, correct?
Right.
Okay, so with options, they do expire. This is why options are a little bit cheaper in theory rather than just buying shares, because you're giving up.
Just to make sure I'm clear here, you're talking about initially you talked about two different things. You talk about buying shares, and then the other hand, on the left hand, on the right hand, you're talking about options. And then, okay, so let's get the shares out of the way. Now you're talking about two different types of options, right? You're talking about call options and put options, right?
Correct.
Okay, got it. That might be where I got.
Okay, and let's narrow this down one more time. Let's just stick to the call side for now. So ignore this right side. Let's just stick to the call side.
There you go.
So when you buy a call contract or a call option, you're literally saying that, hey, for instance, you guys wanted to look at Tesla. So let's look at Tesla. Today, it's trading for $436 per share, right?
Right.
Yeah.
I mean, right here, this is giving me the current price. It moves. It's constantly moving because it's live prices. So it's $435, $434 range per share. That means if you want to own one share, you have to pay $434, $435 for it, correct?
Yes, correct.
Okay.
I made money off of, I think I made $70 on each share then, at least.
Right. Okay. So if you wanted to go out and buy shares, if you want to buy 100, you would have to give up $43,000, right?
Right.
435 times 100 is 4,350, or
Right.
43,500. That's if you wanted to buy 100 shares. When it comes to options, one option contract, now this is where it gets a little confusing, but one option contract is equivalent to 100 shares.
Oh, okay.
Okay.
So,
but then how much do you know to put into that option? Like, I mean, is it a set price, or when you buy the option, one option contract?
the market gives you the price of options right here in the bid and the ask is what someone's asking for it, and the bid See the difference in the prices. You have bid and ask. It's just like an auction.
Okay,
You
yeah.
have so to buy it, I have to buy it for 137. The spread difference. Okay, do you see the two different?
Yeah, what's in between the spread, yeah.
That's where the market makers, those on the down on the floor and doing the exchanging for you, make their money.
Okay.
Are you still following, Mark?
A little foggy on that last thing. But I was trying to look at the little numbers. They're looking very small to me on here. So, okay.
So, they are. They're very small. But the difference between the bid and the ask, which is the buy and the sell prices.
Oh, I see it. Okay, yeah. I couldn't read those words up there. Okay.
Yeah, bid and ask.
Right here, bid and ask. There's always a difference in prices normally because the market makers are making their money in between those spreads. That's how they make their money. And then you have brokers and commission fees. But market makers make their money from this bid and the ask prices.
Okay. So literally like $5 in between each of those, that bid and asking price right there. Right?
What is it?
It's like a $5 spread between those, right?
Yep.
Yeah.
That's where they make their money.
So millions of people buying these options, basically.
Yep. So they make money down there on the floor.
Yeah.
That's how they make money. Mm-hmm. Okay, so let's go back to the very basics. The call option side, when you buy a call option, you're buying for a contract. So if I wanted to do 17 days out, I open this option table up, and that's where I'm working with the 17-day options for Tesla right here. Everything involved is right here. And let's just stick to the basics yet again. Let's stick to these two columns.
Yeah.
And matter of fact, let's ignore the put side. Like I said, if I could block this out, I would. Maybe I can.
No, that's fine. We'll just concentrate on that one window.
Okay. So these are the expiration dates. Let me close all of these. These are the expiration dates. You have June 17th, 2022, September 17th, 2021, and these are the days out. Most options expire on Fridays, okay? Most, I'm going to tell you that. Most expire on a Friday. So that's where, in parentheses, these are the days to expiration. So if you wanted to work with a 32-day contract, you would open up the 32-day contract. If you want to work with a 39-day contract, you open a 39-day contract. There's so many rules of when you want to work with what contracts. We're not even going to cover that. That's why when I teach, it takes months to teach you something because I go over every single thing there is to know about options. And that's anywhere from the platform itself to what expiration days it takes. It's years and years of learning this, but I'm trying to cover literally just the basics of this as I can. But it's hard to because you're going to have thousands of questions. And this is why most people stay away from options trading because there's so many different things to learn about it. But that's why we're all here and I teach it. So, for instance, I want to work with 39 days out. That gives me a little bit of time for the option contract to go in my favor. If I wanted to say that in 39 days, I expect the stock to blow up and go above $435, let's work with the 440. I'm saying, or I'm assuming that Tesla will be over $444 in 39 days. So I would buy this option contract for $7,000. Now you say, well, where do you get the $7,000? Remember, one option contract is 100. So what's 74 times 100? 7,000, right?
Yeah.
Okay. So I have to give up $7,000 to get into this Tesla contract that's priced at the strike price, which these are strike prices. This is what you think that Tesla will be, or what the future price of Tesla could be. So let's back up to what I said about real estate to put it in comparison. If there's a house being built, what's the normal building time of a house today in today's society?
6 months.
6 months. It used to be, 2 or 3 years, right?
Yeah, yeah.
So let's just back up for comparison. Let's say it takes 3 years for a house to be built for whatever reason. We're just putting a time frame. So our contract, are you still following, Mark?
Yeah, I want to.
Okay. So let's say that the house is being built and 3 years from now, we have a couple of things that could go on: the economy, the house, or everything else involved. So we go to the developer, and for instance, it's building in a decent area. Let's say it's being built in Florida, and I'm just giving that for an example because anywhere from $150,000 to $400,000 houses. But he's building a house in a neighborhood that house is probably going to be worth about $200,000. Let's just give or take. So for this example, we're going to go to that developer and I'm going to say, hey, I'm going to give you $10,000 so that I can buy that house when you're done with it for $200,000.
Okay.
I'm giving you $10,000 today and promise that you have to sell me that house for $200,000. And he says, okay, I accept. So I hand him $10,000. Now it's set to be done in, what do we say? 3 years, 2 years? Let's say 3. So I just bought a real estate option contract to buy for $10,000 from 3 years out. So theoretically, in comparison, 3 years out is, over 816 days. But for example, it would look like this. It would show whatever three years out would be. Still following, Mark?
Yep.
Okay. So let's not pay attention to the prices of what's going on. Let's just stick to the math. So a $200,000 house is bought for a $10,000 contract. At the end, let me see if I can maximize this. There we go. At the end of 3 years, if the market is booming, what do you think that house is going to do?
Go up in value.
Hopefully go up in value, yeah.
Okay. So if it goes up to 300,000, it's now appraised for 300,000.
You're
What do
still
you
going to
get to buy
buy
it for?
for what you told him you're going to buy it for. You put your option in there, you're going to buy it for the 190.
Exactly, because I've already gave him 10 grand, so he's going to deduct that from the final price of 200,000 that was promised, and now I have to fork over $190,000, and that's it.
Yeah.
Okay, so what you're saying is you're buying
real estate.
Okay, so $200,000 after 3 years, you've got, and you put in 10,000.
Yep.
Okay, so at the end of 3 years, you got to put in your 190, right? And then, but you said, what if it goes up another 100,000? So there's a gap there of 100. Let's say it went up, like you said, 300,000, whatever. So now you got a gap of $100,000. That's what you're saying, right? And that's
right.
money
That's
that
yours.
you made.
Yep.
Or taxes. Okay.
Yep.
Got it.
Yep. That's where the power of real estate options contract come into play, and that's the power of stock options.
It's pretty much what they do now. You go buy a new house, they tell you put your down payment now so you can hold your house. You can hold your property at the interest rate it is right now, because we can't promise interest rates might go up. And put your money down now and you'll get it for that price. That's pretty much what they do now.
So what's happening is you can do a couple things here. You can go ahead and exercise, meaning you take over that house, you exercise your contract, which is the same term I'm using for options contract in the stock market. So you exercise, you go ahead and buy that house, you pay 10 grand, you go ahead and give up another $190,000. Now you own a $200,000 house and the market says it's valued at 300,000. So you take over your assets, you take control of those shares, and now you just own 100 shares or own a house for 200,000 that's now worth 300,000. So what are you going to do with it?
Sell
So
it.
wait a minute. Now, let's back up a second. So at the end of the 3-year contract, right? You have to come up, but you do have to come up with the rest, the 190,000, right?
Yes.
Okay. So you're doing this with stocks now, right? So in other words,
Right.
if we bought 10 grand in stocks, because you have to pay, how much was it? 10,000 for 100 100 shares of it?
7,000.
Huh?
Seven. You.
Oh, yeah, so
In the
you're
case of
paying-
the case of the stocks, it'd be 7,000 for the 100 shares. The
Right,
stock
okay.
options.
Right. Okay. So then you pay the bill when it comes due for the balance. So if you already got 10,000, so okay, so 190. So then you have to come up with all that money at one specific time. So okay, get it.
If you want to own that asset and exercise the right to buy that house that is for sure priced at 300,000, you have two choices, and that's why I asked this question. What would you do? You can either go ahead and pay for the house and now own the asset, or you can sell that option contract
And you still get your profit.
and you still make money.
So before, put it this way, you got the option. The time's coming up to where, okay, I've made money. That time's coming up to where I'm getting the option to keep it or get rid of it. So you can get rid of it before you have to pay it all to someone else and
Correct.
keep your profit.
Correct.
Correct.
That's where the power options come in, because I only paid 10 grand for a theoretically valued house that's at $200,000. So instead of going to that developer and paying $200,000, I only paid $10,000, and now I control a contract that's almost leveraged even better than taking out a $200,000 loan and going to him and risking that.
Nice. Yeah. Yeah. And your whole mindset is, before this is done, and when the option comes up for me to buy, I'm just going to turn around and flip it.
Yep, because that option contract is now valued at what that house is. So now you can almost sell that off. And this is where Delta Greeks or the Greeks come into play, depending on the supply and demand of this option contract, depending on what the value of that house is. I'm just saying, best case scenario, that house is worth 300,000. Guess what? The next person that wants to obtain this contract that says they get to buy that house for $200,000, they have to pay me the difference. So that $10,000 becomes what around the same amount if you was just to go ahead and buy the house for $200,000. I don't want to confuse you, but I'm saying that's how the options are leveraged and how powerful they can be, because now I can sell this contract that cost me $10,000 to someone to offset the difference if I was to take ownership of that house or that stock. But let's just stop right there. I don't want to confuse the math behind it. I'm just saying that's the options you have, and that's where options are called options and why they're so powerful. But they are risky because you deal with an expiration period, whereas just going out and buying a $200,000 house for $200,000, now you hold on to it forever. So a lot has to work in your favor with options.
Yeah. So do you have to sell before the expiration date? You have to sell before the expiration. So if the expiration date comes up, you either pay it, or if when the expiration date is up, it's up. You have to pay it that day, right?
Yep. If it's in the money, and say this house expiration comes up and it's $201,000, you automatically get assigned it. That means you have to have the funds to cover it, the difference. That's where the broker will charge you the $190,000 if you let it expire and don't exercise it. The broker will work in your favor. That means if it's out of the money, it's going to expire worthless. If it expires in the money, they're going to automatically assign you because someone else is going to put you that contract.
Gotcha. Okay. And my question
and I'm not even going to get involved in that side.
No, we're not on that side. I get it.
Exactly.
But my question is
that's where you've got to come up with $190,000 or go ahead and just sell that contract. That's where you have to go in and put in the order to sell that option contract for more than you paid for it.
Yeah.
Because it's in the money.
So go back to the Tesla. Okay, go back to the Tesla real quick.
Well, let's back up real quick. I'm going to give one other example, Mark.
Okay.
Are you still following, Mark?
Okay, so let me recap this for a second here. I just want to make sure I got this. You have to buy 100 shares, and in our case, we said you had to buy them That's one. That's what was that, a call or a put? I can't remember. That was a call.
We're
Okay.
doing calls only right now.
Okay. Yeah.
Yeah.
Right. I just got them mixed up in my head. Okay. So for a call, you put in, you have to buy in blocks of 100 shares. So in our case, we were talking, let's say they were $100 each. So that's 10 grand, right? And after 3 years, that price would be, why did we decide it was going to be at 200,000? I can't remember. Or was that just, is that a set amount, or is that something that just, it winds up being at?
For the market, you work in set amounts because everything is future based. It's assumptions, it's perspective. So yes, for a house, I'm just doing a comparison saying this is how the numbers work. The market gives you the prices ahead of time. It says if you want to work with the prices of 430, you go to the 430 strike price. I'm just saying in comparison to make this make a little bit more sense to people that don't understand how options work. We compared it with the real estate market because the comparison is much easier to think about because most people are more inclined to just buy a house and then sell it.
I got that. So, okay.
Yep.
So then at the end of that time period, you owe 190,000. You already put 10 grand in for that auction, for that call. And then
Right.
the house in our scenario went up to 300,000, which means you basically made 100,000 off of it, or you're controlling, now you're controlling $300,000 a piece of an investment, right?
Right.
And then you said, then after that, you said you can sell it, right?
Yep. You can sell the option contract as is, and it would be worth a lot more. It's almost, and I don't want to get into the technicals or the mathematical side, but it's almost going to be as much as if someone would just buy the $300,000 house now. So that option contract is going to be in your favor. So you can just sell it for a huge profit, or you can take over the asset itself.
Okay, so
either way, you're still in the green because you're either $100,000 in profit, or you're pretty much $100,000 in profit with $100,000 or $10,000 investment.
Okay, so question: if 300,000 is the top of the market for that, why would anybody spend that much money on it when it's already topped out? I mean, why would they do that? I mean, why wouldn't they try to negotiate a discounted price from you?
They do in the stock market, but you put a limit on what you sell your shares for, right? So the market is like a auction. Where there's a buyer, there's always a seller. Where there's a seller, there's usually someone buying. But that's, I don't want to get into this, but real quick, this is where you look at your, and not to confuse you, but this is where you look at your open interest and your volume. Think of the stock market like a huge auction. If you want to look at a local auction selling tools, fine. If you want to look at real estate, it's an auction. Someone's always probably going to buy that if there's a lot of volume. That's where the supply and demand comes from. And this is where the implied volatility depends on, or the implied volatility drives the price up of your options contract. I don't want to get into all that. I don't want to get into explaining what each one of these are because we're going to confuse people who's going to watch this. I just want to stick to the basics. You're guaranteed.
I'm just trying to understand this a little better. So it would not. I mean, this helps me figure this out a little better though when we talk about this. So you don't have to go in great detail explaining it, but so let's say, for example, the house went up to 300,000, and you wanted to sell your portion to get your money back, whatever way that. But so let's say you put it at 250 instead of 300, just to make it more attractive to an investor. I'm just using that as an example. That's possible to do that, or?
You can, but when you put a value on something, it's valued at it. Someone's going to pay that. If we're kind of like getting into two different things. If this Tesla is worth $500, are you going to pay $500 for it? If you're forced to have to buy it for that, you're going to have to buy Tesla for $500 when you wrote an option contract at 428. So in theory, that house is worth 300. You're going to find a buyer for 300.
Really?
Yep.
Now, okay. So far, so good. I just as long as I understand that scenario a little better, I can figure out what you're talking about. Okay.
This is where people who trade penny stocks get burned because the prices go up and they can't get out of those trades. When you find liquidity in certain stocks like Apple, Amazon's, Google's, Home Depot's, whatever, the liquidity's there. You're probably going to find a buyer to take over that for $300,000 house. So the liquidity market, I said, Mark, if the market goes skyrockets and the appraisal comes out and says, okay, your house is that house that you wrote a contract on is worth $300,000. The market may keep going up, and someone's willing to pay $300,000. Where in a couple of years you decided to sell it in the 3-year mark. In 6 years, whoever bought that house for $300,000 might make another $300,000 because now it's worth $600,000. We don't know that. It's just saying that the market's putting a cap on the expiration dates for you. So if you think that the house is going to go up in 3 years, and it does, that house is now appraised for $300,000. You sell it on the market for $300,000. You can either sell you what's called, you exercise your right to buy. That means your 10 grand forces you into a strategy that you buy a $300,000 house for $200,000. You come up with the other $190,000. If you decide not to take over ownership of the house and you just sell your contract to someone else, you're still making a huge percentage mark because it's going to adjust for the price it's going to cost someone else to take over that $200,000. So $10,000 profit turns into around the difference between the contracts. So it's a huge percentage margin, either $100,000 profit off of $200,000 or a better percentage return on investment of the 10,000. It's just whatever you want to do with it. Some people want to own the assets. Some people just want to sell contracts, buy and sell contracts. There's 2 options there. If the market crashes, this is the other aspect or other scenario. If the market crashes, Mark, in 3 years, and that house was promised to you at $200,000, a market crashes, coronavirus comes around, and it crashes our economy, and that $200,000 house that contractor promised you at now becomes worthless at $100,000. What are you going to do?
Don't you have to pay the contract?
You already bought the contract. You already handed your $10,000 over. It's done.
But the $200,000, don't you have to come up with 100, whatever the loss was?
If you wanted to, this is where you get to do this. You get to walk away. You just lost 10 grand, but you don't have to do anything else. You just lost 10 grand. That house is worthless. That's your other option. That's what most people do. If that option contract expires worthless, it expires worthless. You gave up 10 grand for the risk to possibly profit 100 grand if the housing market went up. But if economics are involved and the coronavirus comes out and that market crashes, you lost 10 grand.
So you don't have to come up with another $90,000.
Nope, you don't have to. That's your obligation to you have the right to buy, but you don't have the obligation.
So all you
on the other side, if the person who sold that contract to you, the market goes against their favor and the market goes up, they have the obligation to sell you that house for $200,000 no matter what. But that's a whole nother lesson. I'm just saying we're on the buying side. So you're not forced anything. You gave up the 10 grand. It's a 10 grand loss, but it's not a $190,000 loss.
Okay.
Make sense?
Yeah, my son made 20 grand the other day doing something like this. Yeah, stock options. Yeah, he made $20,000.
So that's how you do it. That's 3 scenarios.
So it was very risky. He did it. He was kind of nervous.
Yeah, there is risk. I mean, it's do or die. It goes in your favor and you lose the money, or it goes in your favor and you can profit pretty big because the substantial amounts of ROI. This is where, okay, so we're getting in our 40-minute market yet again. Okay, so anyways, the percentage of ROIs are much greater because it costs less, but there's risk. So where there's risk, there's reward. There's never a perfect, never a 100% risk-free out there. Even the corporate bonds or government bonds, they carry low risk, but you don't make as much. That's why they're low percentages of returns. It's 1.9 interest. Okay, well, with options, you get a whole lot better return rate, but there's a whole lot more risk. But if you know what you're doing, and this is a whole nother lesson, you can increase your win percentage by, 80, 90%. I'm not going to go into that, but just for the sake of this lesson, did that make sense? Did it put in perspective what call options are?
Yeah, it gave me a better idea what they.
Excellent. So real quick before our time's up, I want to cover, for instance, if in 39 days, I expect Tesla stock to go from 428 above 430, I'm going to be forced to buy anywhere from $6,500 to $7,000. So that's controlling a $43,000 position for merely $6,000 to $7,000. That's it for 39 days. The market tells you what the prices are. It's controlled by supply and demand, which is theoretically, and a lot of people put it in common sense terms, implied volatility. So the higher the implied volatility goes up, the higher the options are worth. Does that make sense? Implied volatility is supply and demand. As implied volatility increases, supply and demand of the price of the options go up. That's it. We got to keep it simple here. Supply and demand. If you want to think of implied volatility as supply and demand, by all means do it. But the more something becomes more in demand, you're going to pay higher for it, correct?
Right.
Okay. So that's where these option prices ask is $7,000 to control a $43,000 position. Because like I said at the beginning, for Tesla, if we wanted to own 100 shares, we'd have to pay $42,886. That's just right now. Now it changed. But anyways, that range. But for instance, I'm controlling a $43,000 position in the future for 39 days for $7,000.
Got it. Okay, that I understand. Yes.
Okay, excellent. Now I'm going to cut the video off because I don't want to confuse anything else. That was buying calls in comparison to the real estate market. So I'm going to stop the video so we can continue with a little bit more. But for those that's going to watch this video, I hope that made sense. If there's any questions, comment in the comment section.